AVIC Heavy Machinery presents a really fascinating puzzle right now. On one hand, you have a plunging stock price and a sharp drop in profits. But on the other, the company's order books are actually growing. So, today we're going to dissect these conflicting signals and figure out what's really happening under the hood.
All right, let's start with our core findings right up front. First, that big performance hit, we believe it's a one-time pricing reset, not some collapse in demand. Second, the underlying business is showing real strength, with double-digit order growth. Third, the C1919 program looks to be a major engine for future growth. And all this boils down to one central tension: a conflict between short-term margin pressure and what appears to be significant long-term strategic value.
Okay, so let's first unpack the data that triggered all this market pessimism. We really have to start with the surface-level story, what looks like a very weak report card.
You can see the damage right here. The company's stock significantly underperformed, dropping a staggering 14.5%. And what's really striking is that this happened while its key benchmarks, the CSI 300 and the military index, were actually in positive territory. It's clear the sell-off kicked into high gear right after that H1 report dropped.
And that H1 report really tells the story of why the market reacted so negatively. I mean, revenue is down about 4.5%, which is not great. But the real shocker? Net profit absolutely cratered, down almost 33%. This was a massive miss, especially when you remember the company's own optimistic guidance from just a few months earlier.
So this huge gap between guidance and the actual results, it just begs the question, what is the true root cause of this performance decline? Is it a structural problem or something else entirely?
Well, this is where you get two completely different narratives. The prevailing market view seems to be that demand for military and aviation products is collapsing, and that the company is facing a structural, long-term decline in profitability. But a deeper analysis points to something else, that maybe this is a one-time historic price adjustment that's just distorting the financials, and that the issue is more about timing than a lack of business.
Okay, so if we're going to challenge the market's view, we need to find the evidence. Where, in the company's own financial statements, is the proof for this one-time adjustment thesis?
And here it is. This is the smoking gun, really. A nearly 2 billion RMB increase in accounts receivable just in the first half of the year. This is a massive clue. It strongly suggests that products were delivered, but the final payment and pricing were delayed. In other words, the business was done, but the revenue just couldn't be recognized on the books yet.
And this is what's so interesting. This data directly contradicts that demand collapse narrative. I mean, look at this. Newly signed orders are up over 9%. Reserve orders are also up over 9%. This doesn't just show that the order book is healthy, it shows it's actively growing.
All right, so with that context in mind, a temporary hit but a strong order book, let's pivot and look at the future. Where are the new growth engines for this company?
Well, the biggest and most certain catalyst on the horizon has to be the C919 program. The company is a core supplier of critical forgings for this passenger jet, and now that the C919 is finally entering mass production, AVIC Heavy Machinery is set to be a major beneficiary.
So you can think of the growth story in a few key parts. The C919 program ramp-up is clearly the largest piece of the puzzle. But you also have ongoing military deliveries tied to the current 14th five-year plan, and then a strategic expansion into other high-end civilian markets, like ships and energy.
So, to combat that long-term margin pressure we've been talking about, management has put a comprehensive strategy in place. It's called the 3 News strategy, and the entire goal is to extend the company's reach across the value chain.
Let's break that down. Essentially, it's a way to fight that double squeeze from powerful suppliers on one side and powerful customers on the other. First, a new ecosystem means developing their own materials R&D to control upstream costs. Second, a new business format means moving downstream into things like precision machining and assembly to add more value. And third, a new platform is all about using digital and intelligent manufacturing to just get more efficient.
So, that's the potential upside. But of course, for a balanced assessment, we have to look at the other side of the coin. Let's talk about the primary risks and the key indicators you'll want to monitor.
There are really 4 main risks to keep an eye on here. Any slowdown in military procurement or budget changes could have a big impact. A slower-than-planned C919 production ramp-up is another one. Then you have the risk of significant volatility in raw material prices, things like titanium alloys. And finally, of course, geopolitical friction that could impact the supply chain.
But it's crucial to consider the counter-argument. What if this isn't a one-time adjustment at all?
What if this is actually the beginning of a long-term cost reduction cycle across the industry, one that permanently suppresses margins? That's the alternative view.
And that's why we need objective signposts to track what's really happening. You can think of these as potential thesis killers. First, watch the gross margin. If it fails to recover to that 28% plus level in the second half, that's a problem. Second, look at accounts receivable. If that ratio doesn't improve by year-end, that's another red flag. Third, C1919 revenue needs to become tangible and match delivery schedules. And finally, watch the stock price itself. A sustained break below the company's recent buyback price range on high volume would be a very negative signal.
Which brings us back to this central question. It's a classic battle, short-term pain versus long-term value. So which way will the market scales ultimately tip? Will investors look past this current disruption to price in the company's strategic repositioning and long-term potential, or not?